Hello everyone. I, Rohan Dange, welcome you today on our discussion on national income accounting on scholar.com. So today we are going to learn about the very basics of national income. Okay, so let's begin with our lecture today. So as you can see on your screens, we are today dealing with lecture 6, that is lesson number 6. And this is a very basic lecture because I want you to acquaint with the terminology, get acquainted with just the terminology, and also I want you to understand the basics of national income accounting. Okay, so beginning with, I want to talk about a very basic concept or a very basic difference between national wealth and national income. Now, national wealth, it measures the stocks of commodities held by nationals of the country at a given point of time. Okay, you need to focus upon at a given point of time. And when you talk about national income, it measures the volume of commodities. So it measures the volume of commodities and services turned out during a given period. It is a flow, not a stock. So national income is a flow, whereas national wealth is a stock. Now, how do you understand this? Let us try and understand this first. See, income is something which is recurring, correct? You get your wages, you get your salary, you get your pension, right? Salaries, wages, and pensions are all examples of what? Are all examples of income, right? These are all examples of income, including your pensions also, correct? So that is your national income, which is recurring in nature. So you generally get it on a monthly basis, or you might also get it on a what you can say weekly basis. Correct. What about national wealth? National wealth is something that you hold in stock, as you have seen here, right? And most importantly, it is to be held at a given point of time. So it could be property, correct? It could be precious metals like gold, correct? Right? It could be any asset that you're holding, right? So that is your national wealth. Okay. uh Property is not recurring, gold is not recurring, right? So when you save your income and when you create an asset out of that, it becomes your wealth, and the wealth that the country holds is called as national wealth. Okay, that's as simple as that. Now let me give you an example for this. If at this juncture you're still not clear, suppose you walk into big bazaar. Okay, let's take example of big bazaar. Okay, so suppose you walk into big bazaar. On that day, if you walk into the grocery section, the total amount of grocery which is present in big bazaar will be called as the wealth, right? Because it is the stock, it is that day's stock, right? So suppose that stock is worth rupees 10 lakh, right? But the sale on that day, out of 10 lakh worth of stock, the sale on that day is 4 lakh rupees. So that's your income. So income, as I said, is daily also, because daily, at a daily basis also, it is recurring. Every day you get income. So the sale that you make on one day is 4 lakh. So that's your income as Big Bazaar. But the stock that you're holding, right? जो भी माल सामान उस दिन बिग बाजार में है, the accumulation of that is 10 lakh. That is called as wealth, right? So that is the basic difference between national wealth and national income. So I have explained to you the difference between income and wealth. Likewise, the same difference is applicable to national wealth and national income. Okay. So I hope that through this example, the difference between national wealth and national income is clear to you. National wealth, it measures the stocks of commodities held by nationals of the country at a given point of time, right? So today, if I own about 20,000 rupees of gold, that is my wealth in today's time. But suppose I was holding 60,000 of gold about a year ago, then this was my wealth a year ago. If in the next year I am going to hold 1 lakh rupees of gold, that is going to be my wealth after 1 year. So it is always calculated at a given point of time. That is national wealth. National income, however, on the other hand, is not calculated at a given point of time. It is basically recurring in nature. That means it is given to you on a daily basis, on a monthly basis, on a weekly basis. Correct? So it measures the volume of commodities and services turned out during a given period. What was the given period in Big Bazaar? 1 day. How much did we sell in Big Bazaar in 1 day? Commodities and goods worth rupees 4 lakh. So over the given period of 1 day, we have sold about 4 lakh rupees of material. That is our income. But how much complete material we were holding yesterday? That was the complete stock was 10 lakh rupees, was worth 10 lakh rupees. So this is the basic difference between national wealth and national income. Okay. So moving on, before independence, the notable estimators of national accounting or national income accounting were Dadabhai Nauroji, William Digby, Shah and Khambata, VKRV Rao, and RC Desai. Correct. Of which Dadabhai Nauroji is the most well known. In fact, he has given a theory called as the drain of wealth theory. Dadabhai Nauroji had given the drain of wealth theory. Means what? That the Britishers, right, that the colonial masters, they drained out all the wealth from India and they took it with them to UK. Correct? That is United Kingdom. Right? So Dadabhai Nauroji was a notable estimator from pre-independence India who talked about the drain of wealth theory very early in the 19th century. Okay. So these people, these estimators, they estimated the value of the output of agricultural sector and then added a certain percentage as the income of non-agricultural sector. Now see, there was an agricultural sector, okay, and there was a non-agricultural sector, correct? What did these estimators do is they calculated the output of the agricultural sector. Suppose the output of the agricultural sector was 100 crore rupees, right? They came to 100 crore rupees after proper calculation and after proper estimation. And to this 100 crore rupees, they would add the income of non-agricultural sector as a percentage. So suppose the income of the non-agricultural sector as a percentage of agriculture is 20%, then how much you have to add? 20 crore, right? So the total income is 120 crore. Total value of Indian economy would stand at 120 crore rupees, correct? Now, why are we only considering agricultural sector and why are we taking an arbitrarily drawn percentage of non-agricultural sector? Because pre-independence India, the Indian economy was an agrarian economy. The Indian economy was an agrarian economy. It was based on agriculture. So about 95% of the people in India were associated with agriculture or agriculture based activities. So obviously majority of the national income was contributed by agricultural sector and only a small percentage was added as an income of non-agricultural sector, right? And that is why while valuing estimating the value of the output of the Indian economy, we majorly estimated the output of agricultural sector. And these estimates of non-agricultural sector were arbitrary, means that they were not calculated, whereas the estimates of the agricultural sector were calculated. So this was more or less a hypothetical assumption. Okay, it was more or less a hypothetical assumption, correct? So this is about the pre-independence estimates. Moving on, in the post-independence period, the government of India appointed the National Income Committee in August 1949, and the committee consisted of P.C. Mahalanobis, Professor P.C. Mahalanobis, Professor D.R. Gadgil, and Professor V.K.R.V. Rao, and they conducted comprehensive analysis during the post-independence period. In fact, the person you see on your screens is P.C. Mahalanobis, and he is actually the founder of Indian Statistical Institute, which is based out of Kolkata. Okay, so very important. He is a very notable personality. He has contributed to nation building in a long way, in a large way. So such questions could also be asked in the prelims. Okay, so please bear this in mind. Moving on, if I talk about National Income Committee and COSO estimates, I have to talk about certain things. For example, we took a conventional series from 1948 to 1965, right? What do you understand by conventional series? That means we divided the economy into 13 sectors and took an aggregate of these 13 sectors to arrive at our national income estimates. Okay. And which are the methods that we used? We used the net output method. In the net output method, what you do is that in agriculture, the output of each crop is estimated by multiplying the area sown by yield or hectare, right? So the output of each crop will be directly proportional to the what you can say the area which is sown by either yield or hectare, right? That's how you calculate the output of agricultural sector, or that's how we calculated the output of agricultural sector during this time period, which is from 1948 and runs up until 1965. Okay, for animal husbandry, forestry, fisheries, mining, and factory establishments, the estimates of production are multiplied with the market price so as to obtain the gross value of output, right? So, for all the mentioned sectors like animal husbandry, forestry, fisheries, mining, and basically and factory establishments, the estimates which were taken were basically multiplied by the market price. For example, if I talk about fisheries, right? So if 100 kilo of fishes were taken out of the rivers in the month of July, what I will do is I will simply multiply 100 kgs with say suppose 5 rupees. If 5 rupees is the per kg rate of fish, so what do I arrive at? 500 rupees. So this is the output of the fisheries sector, right? So basically the output was multiplied with the market price to obtain gross value of the output. Okay, I hope I am clear to you. Moving on, apart, see, in this we have talked about the net output method. There was another method which was called as the net income method. What have you done in the net income method is that you have added the contribution of small enterprises, the small and medium scale enterprises, and you have also added to that the average earning per head. For example, if there are 100 small enterprises in India, I will calculate it as, and if there are about 500 people working in these 100 companies, then what I will do is I will take an average earning per head. Suppose everybody is earning about 10 rupees, average earning. Okay. So what is the total output? 5,000 rupees. So this is the net income method. Here we are calculating national income based on the methodology of net income, right? In the previous method, we have seen that here we were trying to calculate national income by using net output, the productivity, right? Here in this method, in net output method, we are considering productivity. In net income method, we are considering income, right? So this is the difference between these two methods which were employed between 1948 and 1965. Apart from that, we also need to learn about the national income series, right? So the national income series provided the industrial income data at current prices at the 19 and at 1960-61 prices for the period of 1960-61 to 1970-75. Now let us understand what do you mean by this. See, it is need. I don't have to mention what is industrial income to you, right? Income which comes out from the industry is taken in this, right? That's there. Okay. Now, what do you understand by current prices? Let us understand the current prices and the aspect associated with that. Okay. So moving on, current prices are the prevailing prices. Suppose we are living in 2020, and if a toothbrush costs you rupees 20 today, this is current price. But if the base year is 2015, and if the same toothbrush costed you around 10 rupees, so this is your constant price, because here you are considering the price of a toothbrush and you are referencing it with the base year, that is 2015. So how does it become rupees 20 in 2020? Because of inflation. So the price rise that you find is because not because of the higher demand for toothbrush, but it is majorly because of inflation. It can be also because of demand escalation, but majorly it is because of inflation, right? So from 10 rupees to 20 rupees, there is a 10 rupees hike. So out of that, majority, that is about 8 rupees, would be contributed by inflation itself. So we have to nullify the impact of inflation. If we have to nullify the impact of inflation, we must take a look at the current prices and the constant prices both, right? So here, when I say that industrial income data at current prices and at 1960-61 prices for the period of these 15 years is taken, means that for the entire period of 15 years from 1960 to 76, for the entire period of about 15 years, the base year is taken as 1960, and all the prices that you talk about, or all the prices of goods and commodities that you talk about, are referenced to the year 1960 and 61. Okay. So finally, the Central Statistical Organization brought out another series on national income with 1980-81 as the base year in place of the series with 1970-71 as the base year. See, you have to keep on revising the base year, right? If I'm talking about 2020, can I reference the constant prices to 1960? No, I can't do that. It's not possible because too much as time has passed. 60 years have passed. So I have to take a base year which is closer to the current year, right? Like for example, today we take 2011 and 12 as the base year, right? Right now we are also considering to shift the base year or to revise the base year to 2017 and 18, but that is yet to happen. The current base year is 2011 and 12, so that is a prelims based information for you. So I would like to tell you here at this juncture that today when we talk about national income, we take 2011 and 2012 as the base year. So we do not take the prices of 2020. We reference those prices with the prices of 2011 and 12, and we subtract inflation from that, right? So the Central Statistical Organization, which is the CSO, it brought out another series on national income with 1980-81 as base year in place of the series with 1977 70-71 as the base year. Okay. So if I talk about the trends in national income growth and structure, it is necessary to understand the impact of planning in India. See, we had embarked on a planning process which was centered around a 5-year plan, right? So for the first 5-year plan ran from 1951 to 1956, right? So likewise, till about 2014, when Niti Aayog was formed, up until 2014, we actually had a planning model in India, a centralized planning model in India. Okay. And the impact of planning in India had a resultant impact on national income, right? Because every 5 years, different plans were laid out, different programs and policies were laid out every 5 years. And these plans, programs, and policies would have a certain kind of impact, a positive impact or a negative impact on the national income. So, if we have to understand the trends in national income and its growth and structure, it is very essential to understand the impact of planning in India. Okay. So when we talk about the trends in income growth and structure, the figures are taken at current prices. But when you talk about current prices, they do not give a correct picture of the economy. I've told you, right? If I talk about India's economy today and if I talk about the national income, I cannot take the prices prevailing at 2020. I have to take the prices which were prevailing for the same commodity in 2011 and 2012 because that's the base year, and I have to use the base year because I want to nullify the impact of inflation, because inflation in the last 8 years must have contributed to price escalation. Price to badi hogi, right? But that increase was because of inflation majoritarily speaking, and less because of a hike in demand, right? So when we take figures at current prices, it does not give us a correct picture of economy. Again, something which can be asked in the prelims. Okay. So national income at current prices reflects the increase in production of real goods and services, right? And the rise in prices. So what happens when you talk about the increase in production of real goods and services and the rise in prices? You are talking about inflation. So whenever national income is calculated at current prices, it is going to reflect upon the rise in prices, that is inflation. Okay. Moving on, the national income figures are deflated at constant prices. Okay, right. Now, why you want to deflate is because every year there is an inflation. So every year there is a price escalation. You want to deflate that. How do you deflate that? By using constant prices. How do you use constant prices? Again, I'm repeating, by using the base year, which is currently 2011 and 12, right? So when you talk about the national income at constant prices, the prices become comparable, correct? Because all the years 2012, 13, 14, 15, 16, 17, 18, 19, 20. The prices in all these years are reference to which year? 2011 and 12. So the economy in all these years can be compared. And why can that be compared? Because in all these years, the impact of inflation is zero. Why? Because I'm not talking about these prices. I'm taking prices at 2011 and 12 levels, right? So all the years, the performance of my economy becomes comparable in all the years. But on the other hand, when you talk about national income at constant prices, it conceals the population effect. It hides the population effect. It does not reveal to you the impact of population. See, what happens is there is a concept of demand and supply, right? If the population increases, then demand will increase. If the demand increases, then the prices will also increase. Why? Because of inflation, correct? So when we take constant prices, that means we are ignoring the prices which were in prevalent in these years. That means we are also ignoring the demand escalation because of population in these years. Correct? So how much population has increased and how much it has contributed to the growth of economy, that aspect sometimes is hidden when we use constant prices. Okay. I hope you are getting a good gist of it. So to eliminate the effect of growth on population, per capita national product or per capita income is calculated at constant prices, because we want to eliminate the effect of growth on population and per capita national product. How? See, today there are 10 people and they are buying 10 pens. So one person is consuming one pen. Tomorrow there are 5 more people added to the economy because they are born. So how many people we have in economy? 15. And if they are using 15 pens, so how many pens are being used by per person? One pen only. So per person increase has been there or not? No, it has not been there, right? Because it only the population has grown. But has the consumption of the population grown? No, the consumption of the population has not grown, right? On the other hand, if there is a population growth by 5, so again it is 15, but now there are 30 pens which are consumed. That means per person there are 2 pens which are consumed, correct? Now this is an actual growth in consumption, because previously one person was using one pen, But after this, now one person is using 2 pence. So this is actual economic growth. In this case, when 15 people were using 15 pence, the average was still 1 pen per person. In this case, economy had not grown, right? So therefore, to eliminate the effect of growth on population, the per capita national product is calculated at constant prices. Okay. So you can, on your screens, you can see the trend and you can chart out the growth of India's population and per capita income. Okay. Such trends are also asked in the examination, friends. So I hope you are taking a good look at such graphs also, right? So sometimes it has grown, sometimes it has decreased. So has there been a steady growth? No. Has there been a steady decline? No. It has been fluctuating, right? Per capita income growth in India is fluctuating along with population growth, as we can see on the bar graph, right? So moving on to current affairs of the day. Today I'm going to talk about deposit insurance. Now, what is this deposit insurance? The government has set up Deposit Insurance and Credit Guarantee Corporation under RBI to protect the depositors if the banks fails. Why? Because we have seen a lot of banks which have failed in India very recently, like Yes Bank and Punjab Maharashtra Cooperative Bank very recently. So when the banks fail, the depositors, they lose their money. The depositors, they lose their hard-earned money. So the government of India has set up a Deposit Insurance and Credit Guarantee Corporation under RBI to protect the depositors if the bank fails. So the government has decided to increase the insurance cover for bank depositors to rupees 5 lakh, which was previously only 1 lakh. That means if I had 10 lakh rupees in my account in Yes Bank, but now Yes Bank has completely broken down, it has collapsed. So does that mean that my money has been lost? No. Because I have an insurance cover of 5 lakh rupees, 5 lakh will be given to me by DICGC, right? So this is the provision that the government has done. And because of Yes Bank and cooperative banks, DICGC is in use, and therefore again it is a high potential area for prelims, right? So this is the first time since 1993 that the deposit insurance cover has been raised from 1 lakh to 5 lakh, right? So the DICGC Act will have to be amended to increase the deposit cover, and the increased in deposit insurance to rupees 5 lakh will increase the bank operating cost to these institutions. Even the bank's costs will increase, and the premium paid by the insured banks to DICGC is required to be borne by the banks themselves. See, banks will also pay a premium. So this is about premium cost. Okay. When you buy insurance, don't you pay a premium? Of course you pay a premium, right? So when the banks also buy insurance, they will pay a premium, right? And who is going to pay this premium? It is not the people, it is not the depositors. The bank itself is going to pay the premium, right? So the DICGC insures all bank deposits such as savings, fixed, current, and even recurring. Okay, again, this could be asked in prelims. So remember that all bank deposits such as savings, fixed, current, and recurring are included in this. Deposits not covered by the corporations include those of foreign governments and of central and state governments. Okay. And deposits of state land development banks with state cooperative banks, interbank deposits, and deposits received outside India, and those specifically exempted by DICGC with the prior approval of the banking regulator are not covered. Then what is covered? Only savings account, fixed account, current account, and recurring deposit. Okay. So if I have to summarize today's lecture, we talked about pre-independence estimates of national income. We have talked about post-independence estimates also. In the National Income Committee and CSO estimates, we talked about Central Statistical Organization. In the trends in national income and in growth and structure, we talked about the constant prices and the base year effect. We have seen how base year nullifies population growth and its impact on economic growth. We have seen how base year nullifies even the impact of inflation, and helps us give us a correct and a very accurate picture of the economy. In the current affairs decks, we talked about deposit insurance in India. Okay, so with this, I conclude today's lecture. So in the next lecture, we will be talking about the national income accounting part 2, in which we will go into greater detail and depth to understand how national income is actually calculated in India. So this is myself, Rohan Dange, signing off. Happy learning and keep social distancing. Thank you.